Hey, puppy trades. What's that picture? Oh yeah, that I was looking. I'll tell you guys why I was looking at that. And this is where the magic happens. Last day of 2023. All the YouTubers, right? That's what everyone says. I'm a YouTuber. I'm gonna short AMD and Merc because this guy's a YouTuber. I don't know why. I always remember that one. That guy was like, I'm shorting AMD and Merc because this YouTuber is, bullshit. I was like, I'd probably stick with like Ebon. Yeah. Ooh, what was that? What was that, pup? No, I still have I don't even have a setup. I've been doing this for 3 years. I still don't have like a setup. I have to do a makeshift setup every time I record a video. My little focus list I was working on. Yeah, I've noticed a lot of, I don't mean to be, but, I don't have work on Tuesday. I don't have work on Wednesday. I don't have work on Thursday. I don't, the weekends aren't even really the weekends. For me, and the weekdays aren't really weekdays. I don't really care. The only reason I can distinguish them at all is that people I care about work on the weekdays and the stock market's open on the weekdays. That's the only difference to me. And, if I was going out and about, things would be less crowded. Anyway, yeah, I don't even have like a setup at all. This mic, someone got me this mic and this little boom arm, and that's it. I've filmed videos in my car throughout a lot of 2022 just because roommates and neighbors and noise complaints and stuff like that. I read someone say they're going through real hard economic times, and this was kind of the last month and year they knew they had a place to stay and all types of stuff. And I know people shouldn't go on Finchwit or YouTube or anything like that for markets, but to me personally, I can't imagine. I mean, I know things happen. I don't want to be like elitist or anything, but I can't really. This is the golden age of income investing for me. I mean, there just genuinely, there's a lot of stuff that I've had. I actually asked ChatGPT about a bunch of calculations earlier this year, what my dividends could be, what they could grow to, the rate of growth, and all that. And it was saying none of these things were possible, but it was still gonna give me these theoretical calculations anyway. And I hit a lot of these targets and goals, and I actually really surpassed them. And the craziest part is that the exponent, I've actually kind of slowed it down a little bit, but the opportunities and the ways to keep growing the monthly dividend and even diversify it and make it safer are exploding. This is the ETF I've talked about a lot. HIGH. Ooh, see? This is what I'm telling you guys. I mean, this is what it really looks like. I mean, and you know why? Ooh. The reason people don't retire ever is because they don't really see, money that I make from these ETFs sitting on my bum as being equal as the money, that they make working really hard. And it is, and that's kind of part of this religious stuff that we have ingrained. What I was going to show is that a lot of these ETFs, income ETFs that have come out recently, they've really come onto the scene. Let's look at this, and they're paying massive. Geez, the Nasdaq has not updated. Has not updated. Oh, actually, yeah, never mind. Yeah, I mean, this is why I don't make too many, videos. I don't really have a setup, and you know, even when I'm retired, even when I, you know, it it's not really. I don't know. People think that the money that I get from this ETF or you know this ETF, this one's done very well too. CLOZ. But what I was also going to show, we can go look over here at these betas. They're actually a lot less volatile than the S&P, and they're paying out pretty large size distributions. Clause, the Nasdaq, not very useful. Yeah. Now I wanted to show you guys kind of what the behind the hood really looks like. Jesus. Yeah, the Nasdaq for dividend yields, pretty worthless website, unfortunately. Let's see. Stockanalysis.com, typically more useful. I think this one gives the aggregate dividend yield. But yeah, a lot of these ETFs that have come out, everyone just kind of said they were fads or whatever. These credit spread incomes from 3 months T-bills. I mean, this is pretty impressive. 9.40% yield, 99.99% holding treasury bills, short-term treasury bills even, beta 0.29. 70%, 71% less volatile than the market statistically. Let's look at some of these. Clip, KLIP, 61% yield. I mean, a lot of people said there's just no way. There's just no way this is even possible. And you know what's crazy? That this is a pretty, this would be the highlight of, 20. Look at this. Clip. Would you believe this? 7.6% yield, investing $10,000 and dripping Clip. But look at this. And first off, this is while K-Web has gotten crushed during this time. But look at this. The lump sum, 7.6%. During a pretty bad year for K-Web. But the person who just blindly dollar cost averages into Clip, which is selling covered calls on K-Web, taking advantage of that really high implied volatility. Look what happens to the annualized return when they dollar cost average in. Yeah, I mean, and this is a big theme of the video that I wanted to do, is that this is what it's like behind the hood. It can be pretty gritty. And I love it. I've never felt like I've been working a day in my life. Look at this. The yield goes up about 4.5%, just blindly averaging into Clips. That's a pretty high dividend payer for me. Some of these are new. I've been investing in some new ETFs. But yeah. There's been an arms race recently. Bali, FEPI, and BlackRock's got two websites. Wow. Bali, FEPI. There was one more with an I even. But yeah, there's an arms race brewing. So what this ETF is doing, this is, I believe, BlackRock's kind of challenger to JEPI and JEPQ, and we've seen Morgan Stanley release theirs recently. Poppy, PAPI, and we can talk about some of those. The Morgan Stanley ETFs, they're trying to get really out there. They're getting naked options involved, so I'll probably talk about that in a different video. I've been investing in Bali recently. It's an active large cap exposure, systematic stock selection process, seeks to benefit from data to uncover insights faster at greater scale and with more precision. I mean, they're really trying to, get some alpha out of this. Seek to enhance monthly income, seeks to enhance dividend yield by selling call options, target potential growth, active large cap core exposure that seeks to provide upside potential while managing volatility. The BlackRock Advantage large cap income ETF seeks consistent income with lower volatility than the broader U.S. equity market. Paid some dividends so far, it looks like. Yeah, paid about 20. Look at that. Really? Was that a dividend every 2 weeks? No. Yeah. Yielding pretty hard right now. We'll see. What's the, they've got their yield probably right there. 9.40% yield. And very little body of work right now for these ETFs. But it is interesting that a lot of them came out right around the time. Bali, look at this. 46% since its inception. I mean, wow. And that's paying out a pretty nice dividend along the way. Let's look at SPY during that time. And this is during a ripper. There's no way this beats SPY, is it? 46. Oh, yeah, it didn't. Okay. I was going to say that would be wild. But anyway, as very few things, if they are only being measured during a 6 month or 6 week, 8 week, kind of historically fast ripper, like we've seen, are going to be beating the NASDAQ or SPY just generally, unless it's on a risk adjusted basis, which is certainly an important way to look at it. FEPI, though, might have something to say about that. And obviously SVOL would also have plenty to say about that. FEPI. We look at FEPI, it's actually, it actually has challenged QQQ to the upside. It's actually beaten QQQ in total returns to the upside during a straight ripper. Why? Because it's buying and holding out of the monies. It's buying and holding its favorite tech stocks. It's got this. We can just look. Yeah. So what it's doing is it's buying the best big tech stocks. Right now, it's yielding 25%. I mean, that's kind of nuts. Both of its, and why could it be doing this? It's because if we look at these holdings, let's see. If we look at these holdings right here, what kind of comes to mind? Pretty volatile names. Intel, Micron, Netflix, AMD, Tesla, Google, Facebook, Amazon, Broadcom, and Salesforce. What have we kind of also noticed about that? Kind of seems like they've been stock picking. It's not the usual Microsoft, Apple, Microsoft, Apple, Nvidia, and it's not just the usual These managers will actually be stock picking. And we look at their perspectives. I think that they say they've got a special index they're following. But they're really going at it. And that's only for an expense ratio of 0.65. I didn't read Bali's expense ratio, but I'm pretty sure it's competitive with that. The new ETFs, Poppy, and another one from Morgan Stanley that we can look at, expense ratios of 0.29. So we've got an arms race brewing. These big boys are trying to undercut each other and create the next super ETF. I think that right now it's good for the little fishes. It might not be good for the little fishes for a long time if the whales, get a little too destructive. And what I mean by that is now Morgan Stanley is just straight up selling naked options in, an ETF. In their perspectives, I mean, I should probably do a different video. Morgan Stanley dropped 2 crazy ETFs. And one of the big themes I wanted to make for this video was that, the aliens have invaded. That was a big thing. The aliens invaded in 2023. They really did. And they certainly invaded the active management market. And so, and the buy right market and the covered call market. FEPI is a great example of that. Let's just look at this fact sheet real quick. Get some officials. So what's their objective? They're going to combine equity. The Rex Fang Innovation Equity Premium Income ETF combines big tech stock exposure and potential for steady income in a covered call ETF. It owns big tech. It writes covered call options. And it has high income potential, but the big key is that it's out of the money options. FEPI aims for steady high income by selling out of the money call options, harnessing big tech's volatility, and only doing it for a 0.65% expense ratio. They've been stock picking, they've been rebalancing. Are they going to do it great? Are they always going to sell the right options? Probably not. Let's see if we can see what they're selling right now. Let's see. I'll have to download all this. YOLO. No, I don't want to YOLO that actually. Anyway, next ETF, JEPQ. Right, this is the one that started all this. JEPQ. I mean, I talk about JEPQ a lot. So JEPQ's total returns 12.18%. Now that the NASDAQ is at an all-time high, it's no longer outperforming QQQ. I don't believe. Notice that for JEPQ, though, what I do think is interesting. Now, from a risk-adjusted basis, let's see, from a beta standpoint, and a risk-adjusted basis, JEPQ has a beta of negative 0.84. That doesn't really seem right. The implied volatility of JEPQ, however, might be a little more accurate of an assessment of where the volatility of this ETF is going to be based on the people who are buying options to hedge with it. We got about a 7% implied volatility compared to 15%. So right now the NASDAQ is implied to move twice as much as JEPQ over the next year. That might be one metric of volatility. Another metric of volatility would be that JEPQ is paying out its gains, and it's doing it in the form of a dividend. Whereas a QQQ investor theoretically can lose all of their gains. Everything that they own is on paper. All of their gains are on paper. JEPQ, and in a very similar example, would be some of these yield max ETFs. Coney, it's been, and this is not a forward dividend. This is just taking the aggregate, and this is acting like Coney had only paid 3 dividends for the entire year, and is would only pay 3 dividends a year, even if that were true, it'd be yielding 16%. The truth is that's not the case. It's actually gonna pay about 9 more dividends each year than this, and I think right now it's yielding about 98% forward. So, but the bigger thing is that as Coney has gone up, whereas a Coinbase investor theoretically could wake up tomorrow and find out that Bitcoin was made illegal, Coinbase was getting probed, whatever, and we've seen how volatile cryptocurrency backed things can be, and we've seen Luna, literally crater to nothing overnight, and Coinbase, an investor in that theoretically is bearing that risk. Coney, as time goes on, they're actually getting compensated, and that risk is kind of getting crystallized for them. So anyway, that's kind of going to be my touching on the Yield Max ETFs. I love the Yield Max ETFs, and for me personally, if I'm bullish a Yield Max ETF, if I'm bullish a stock that's underlying a Yield Max ETF, especially if the implied volatility is high, I think we've seen that, if I am bullish Yield Max holding, for the long term, Amazon, Disney, Nvidia, Tesla, AMD, Coney, Coinbase, even I think when oil gets started, this ExxonMobil ETF is going to be very interesting. It's also taking advantage of out of the money calls, and a lot of people, just because what did everyone say? They think about how prejudiced there was. A little bit of prejudice in this, right? Because think about how everyone said just because Tesla and ARK were the first ones, people wrote off Yield Max. Well, guess what? Yield Max later dropped ETFs on that ran these synthetic covered calls on Microsoft and Nvidia later, and for some reason no one had a problem with these ETFs that were selling synthetics on Microsoft and Amazon. And the whole point was that people said these were going to be a fad, and in my opinion, to a lot of lost money, to a lot of a lot of that really wasn't the case. A lot of opportunity costs, as we might call it in economics. AMZ, pretty, that this wasn't possible in 1929. It wasn't possible, June 29th of last year. But that if I was bullish Amazon, if I was bullish Disney for the long term, Tesla for the long term, Nvidia, Coinbase, the NASDAQ, JetQ, some stock pickers at Selective. I mean, that's not even to mention, hey, guess what? Doesn't look like, I don't know who thought that 0 DTE puts on the NASDAQ was going to be a zero risk strategy, or that it would be done for free. But it so far hasn't been a fad. Yeah, during a bull, actually pretty crazy gains from QQQY. And that's all being crystallized again. Whereas a NASDAQ investor could very easily see all, of the gains just completely erased for not just the quarter, but for the year. Look at these dividends from QQQ. 0.62, nothing. JetQ, QQQY. And that's just for the NASDAQ. For the S&P, there's almost 1 million ways to get dividends from it. And, again, getting crystallized over time. These distributions will never, ever have to be paid back. The IRS, the IRS will call. Yes. These investors are not immune from the tax man. Surprisingly, these people in many situations can actually be much more favorably, getting taxed than the W-2 earners. But anyway, I am certainly, I got a guy for taxes, if you know what I mean. Let's look at some of these. Oh, BDC. I'm going to be buying this BDC. OBDC. OBDC. Blue Owl, new BDC on the block. Yeah, I'll mark up the Elliott wave. So someone who had just lump summed, I mean, and we have this broad narrative that like fixed income has been dead. You know, first off, let's just look at the total return chart. The total return chart looks quite a lot different than the price chart, doesn't it? I mean, price chart, retail sees it on FinTwit. Total return chart, retail doesn't see it on FinTwit. And they're also not reminded that a lot of those returns have once again been crystallized with dividends that will never be paid back. So, I mean, I guess a big theme. I tried to make this video about aliens, alien fund managers. I thought that'd be cute. SVOL, Simplify, what they're doing. And I think a lot of these, the truth is, alien fund managers have been around for a while. Eaton Vance has been doing what I've considered some alien activity with their ETFs. And I've got two of them written down. ETY, I'm planning on buying. EXG, I'm planning on buying. One of those is 4% below. It's trading at a discount right now. EXG is trading at about a 10 or 11% discount last I checked. Black Rocks, they have a commodity resource trust ETF, BCX, that I'm interested in. I believe that's also trading at a pretty large discount. But, I think that in my experience, what keeps people from achieving their financial goals is that they really don't see that there's a huge difference between money that is made when someone is sitting on their ass collecting a dividend from a boring chart that looks like this, or a boring chart that looks like this, or a chart that's tracking tech stocks. Their 401k is going to have them in anyway, and now it's going to be paying out, big ass dividends. JetQ. I mean, even JEPI. I mean, we've seen value. Value has been in the dividend growth in boomer sector, has been extremely boring, right? But even this ETF, this ETF, what would you look at it and say, right? Dead money, losers, and that's because the dividend isn't being put on the total return chart. And I think it's very interesting that Robinhood lets its users buy leveraged ETFs on various instruments like Tesla and market, all types of leveraged ETFs on the market. But it doesn't let its users buy closed-end funds, which I think is very interesting, because if I was running a brokerage and I really cared about the financial freedom and enough to even make my whole theme wealth distribution and helping young, or not even young people, but oops, sorry, my YouTuber setup fell again. YouTuber alert! YouTuber cleanup! Sorry. My YouTuber setup fell up. Whoop. Yeah, people probably thought it was dumb for me to, learn about the market, Anyway, look at this. I mean, 12.39% return since inception, and it looks boring, right? But again, it's owning the best stocks in the market. You know, honestly, the backbone of, the American market, and it's boring, right? It's too boring for a lot of people. And I'm not here to, say that, it's time to be boring. I think microcaps and, biotechs and clean energies and, even still plenty of crypto innovation sectors, are getting ready for some love. What's the beta here? 0.62, right? 12.89% average annualized total return for JEPI, 8 or 9% annual return. And it's, 38% less volatile than the S&P. You look at the price overview, it looks like it's dead money, it's nothing. But if you look at the total returns and what the fund's actually meant to do, again, the theme continues. Big dividends. A lot of new ETFs are just trying to, with these high yields, replace cash. I've got some of them written down right here. EVSB, I'm probably going to be nibbling on. BXSL, that's not in the description I just had. I just wanted to give a little bit of a competitor to OBDC. These are the newer ETFs in this kind of fixed income sector. BXSL, also a new kid on the block, also doing very well. But once again, let's look at this. $10,000 invested into BXSL, blindly dripping 14.87%. Again, in a period where fixed income is supposedly dead, all types of crazy, assumptions that we've made about income that are very disprovably true, and the yield goes up 4.5%. The return goes up 4.5% when the investor just chooses to blindly drip into it. And this is something that can be seen with a lot of the best actively managed funds, is that, after enough, past performance isn't indicative of future results ever, but after a while, you start to see that the better the act, especially in the realm of actively managed funds, there's a lot of funds where it doesn't matter how good the analysis seems to be with timing the ETF, the return gets dramatically better when the fund is averaged into, I think this is an example right here, EXG. I'm going to be scaling into this. The big caveat with closed-end funds always is that the expense ratios are naturally going to be higher. There are sometimes good reasons for that. There are sometimes very bad reasons for that. So that's something that is rule number one. Is the return really the exact same? No, it's not. EXG. So we're going to see, is the investor rewarded for averaging? Yes, pretty substantially, 3.5%. ETY. We'll do the same time frame. No averaging. 7.12. So ETY is better. Glad I made this video. Let's see what happens when the averager goes. I think this is trading at about a 4% discount to NAV. Wow. Again, there's a lot of ETFs where the total return over time, especially if it's actively managed, can be found where it's almost 20 to 25% higher, blindly averaging into it. And that's a pretty big statistical edge that's also kind of discouraging, timing the ETF itself. BCX, very much focused on commodities. I think it's trading at a pretty steep discount right now. Not the greatest total returns since inception. Let's see what happens when someone averages in. I do think commodities have been in a pretty bad cycle. But notice the return goes, so this kind of enceived. If we look at a chart of silver, I'm pretty sure a lot of commodities, major tops put in 2011, right? And so that's what we just saw was that if the investor lump sums 10K and doesn't average, they just reinvest the dividends, it was dead money for the past 10 or 15 years. But when the investor chose to average in over time and dollar cost average and use that volatility and that active management to their advantage, the return went from 1% annualized, 1-ish percent to about 6.5%, 6.33%. So there is, and there was another ETF before I get sidetracked, just an example of what is going on in this market. I mean, this is hot off the shelf. Oops. Hot off the shelf. What? Where is it? There it is. Yes. Look at this. Woo! Okay. Now this ETF is crazy. This is the arms race that is going on. This is why I wanted to make the theme kind of like aliens were, invading the market. So this is their total return fund, STU. I'll look at STU later. Trading at a 20% premium. Must be a good fund. What is the name of this fund family? Maybe a good idea to make people able to buy your ETF is to not hide it. SRH. What is your fund family's name? I mean, this is also what I wanted to show you guys. There's a, little bit that goes into it. Good Lord, man. What is your fund family's name? Is this a Ponzi scheme? No, that's not your fund family's name. Okay. Home. SRH funds. There we go. Now I need to talk to a leprechaun. And he's going to show me what I'm looking for. There we go. Okay. Brand new. Woo! 0.75 expense ratio. This fund, under normal circumstances, is going to invest at least 80% of its assets in real estate investment trust REITs that are publicly traded on domestic exchanges. In addition, the fund strategically implements an option strategy consisting of selling U.S. exchange-traded covered call options on the REITs in the fund's portfolio. So look at this once again. Expense ratio 0.75, monthly distributions, buying the best real estate stocks, selling options on them, and look at this right down here. Look at these options. I calculated this last night. I think it's over like $2 million in premium. Don't quote me on that. But it's an awful lot of premium that this fund is collecting. And it's this is something that was not even conceivable that this type of thing would exist 18 months ago, and now an arms race in this market has existed where ETFs like FEPI, SRHR, Bali, BALI, they're competing with JEPQ, they're competing with SVOL, they're competing with, Yield Max and Global X, the fund family that started all of this. They've been completely lost in the dust. They've been completely lost in the dust. They're now trying to fight back. So this was the last one that I was, and this wasn't even to mention that the whole 60-40 bond portfolio now, BlackRock has released buy right ETFs for every single component of that. And there's a lot of collateralized loan obligation ETFs like CLOZ, and those are completely different debt instruments that, people honestly have not even heard of. I mean, because they weren't offered. The 2022 bear market created a huge demand for income and stability, and a lot of these innovative things that were previously only open to private investors, large institutions, for a 0.5% management fee. The Panagram BBB CLO ETF seeks current income and capital preservation by investing primarily in a diverse portfolio of CLO, BBBs, and double Bs. So there's a lot of collateralized loan obligation ETFs. That's just one of them that I've been buying. I'm going to keep buying. This is my focus list right here. I think the SRHR ETF is going to be on it too. The last one that I wanted to talk about that I have been buying is I'm going to be doing a combination of IEMG and EMCC. So this is an ETF from Global X. I think RYL, and also, I mean, I like, I like QQQY. I like JEPY, those zero DTE ETFs. Right now, what I want to do, I like the Royce Value Trust. I'm going to blend the Royce Value Trust. That's a Russell 2000 alpha play, a equity REIT that pays out a lot of its income in the form of monthly or quarterly distributions, but it also outperforms the Russell over most time frames. And so I'm going to pair that with IWMY. I already owned a good amount of RYLD. I've been using those dividends to accumulate other things. But anyway, EMCC, is probably with RYLD my favorite Global X income fund, and it's the newest one. I'm going to be buying it. I have been buying it, and I'm pairing it with its underlying holding, IWMY. The net expense ratio is 0.60. If I look at IWMY, I'll do, I did a little bit of not IWMY, IEMG. Still getting used to that ticker, IEMG. This dividend it's kind of interesting because this pays a 2.89% dividend, the underlying. So I'm going to blend it with the underlying. It might make more sense to just do IEMG itself. But the emerging markets is probably the more liquid ETF more people are familiar with. I am bullish the emerging markets, and I'm planning on buying the world. I'm looking for a little. I think the MMs are too. Looking for a little bit of global exposure. So a 2.89% dividend yield. I'm planning on blending this roughly 50% with this net expense ratio of 0.60. Tough to get a dividend yield right now. I think based on that last, very tough to get a 24, 18, if we did 23. Yeah, so it looks like it's yielding, 9-ish, 10-ish%. We'll get a better feel for what this dividend yield is going to be in the future. Really, the only one I would add to this is I'm bullish Disney and I'm bullish AI, and like I said, whenever I'm bullish, yield max stock, I like to blend it with its underlying. But Disney, in particular, is interesting because it's very much it's a little more of a value play. It's kind of, I can put lots of money into Moderna. I can put lots of money into AIYY, right? But, and lots of money into Coinbase. But really, it's about stability. I think one of my, at least for the first quarter, besides these ETFs right here, I'm going to look to blend. What's Disney's book? It's only 55% above its book value, 1.86% price to sales. We'll see. I think I can wait for the mouse to come back, collect some dividends along the way from DSO, and the rest of these funds right here. It's not, the prettiest video, but I'll think of something cool to say on Tuesday when I'm not working.